Could the market collapse soon? We analyze the historical and current P/E ratio of the S&P 500. Welcome to this analysis of the stock market. Today, we'll explore one of the most discussed and closely watched metrics by investors: the P/E ratio, or price-to-earnings ratio, of the S&P 500 index. The P/E ratio is a financial indicator that compares a stock's current price to its earnings per share. It is calculated by dividing the stock's market price by the earnings per share over the past 12 months. This metric is crucial for investors as it helps them evaluate whether a stock is overvalued or undervalued relative to its earnings, enabling them to make informed investment decisions. A high P/E ratio can suggest growth expectations, while a low P/E ratio may indicate that the stock is undervalued. In this chart, we'll compare the current P/E ratio of the S&P 500 with its historical average since the index's inception. As you can see, the P/E ratio fluctuates over time, reflecting investors' expectations about the future economy and corporate earnings. Historically, this index has shown peaks during periods of economic growth and declines during times of crisis or uncertainty. The S&P 500 was created in 1957 by Standard & Poor's and is currently composed of 500 of the most representative companies in the United States, spanning sectors such as technology, healthcare, finance, and consumer goods. Over the decades, the index has reflected the growth of the U.S. economy, as well as the fluctuations caused by factors like recessions, changes in monetary and fiscal policy, and technological advancements. Currently, the P/E ratio of the S&P 500 is above its historical average. This means that, relatively speaking, investors are willing to pay more for the earnings of companies in this index than in the past. This phenomenon can reflect expectations of future growth but may also indicate overvaluation, especially if there isn't a proportional increase in expected earnings. Historically, peaks in the P/E ratio have been associated with speculative bubbles, such as the dot-com bubble in the 1990s and the housing bubble in 2008. Conversely, periods when the P/E ratio was below its historical average have generally coincided with recessions or times of economic uncertainty. The P/E ratio is not just a standalone figure. Several factors can influence it. The first is the economic cycle. During economic expansion, corporate earnings tend to rise, which can justify a higher P/E ratio. However, during periods of slowdown or recession, earnings are impacted, and investors adjust their expectations, potentially leading to a decline in the P/E ratio. Another important factor is the interest rate. When interest rates are low, investors are often willing to pay more for stocks since alternative investments like bonds offer lower returns. Conversely, if interest rates rise, investors may seek more attractive returns outside the stock market, causing stock prices to fall and the P/E ratio to decrease. The P/E ratio is also influenced by external factors, such as fiscal and monetary policies. In recent years, ultra-low interest rate policies implemented by central banks have encouraged many investors to buy stocks, leading to an increase in the P/E ratio. Additionally, growing government intervention in the economy, such as economic stimulus packages, has generated positive market expectations, which in turn can elevate the P/E ratio. However, if these policies change or if the economic environment deteriorates, markets could experience corrections that impact the P/E ratio. Is the market about to collapse? Although the current P/E ratio of the S&P 500 is above its historical average, this does not necessarily mean the market is about to collapse. Several factors could justify this elevated level, such as the low cost of financing due to low interest rates and high expectations of long-term growth. However, a high P/E ratio could also be a warning sign for investors, indicating that stock prices are too high compared to the actual earnings of companies. In this context, investors should consider other indicators, such as the earnings growth rate and macroeconomic prospects, before making hasty decisions. A comprehensive analysis can help mitigate the risks associated with a high P/E ratio. In summary, the current P/E ratio of the S&P 500 is above its historical average, suggesting that the market might be overvalued. However, this indicator should be analyzed in context, considering factors such as interest rates, growth expectations, and the economic cycle. Investors should pay close attention to market signals and maintain a disciplined approach when making investment decisions. It's crucial for investors not to rely solely on the P/E ratio but to conduct a deeper analysis of the overall economic situation before making significant adjustments to their portfolios.